In November 2022, 3 million people woke up and discovered that the cryptocurrency exchange they trusted with their savings had stolen their money. Not hacked, not lost, not misplaced through negligence, deliberately stolen by the man who built it, who testified before the United States Congress about responsible crypto regulation, who appeared on the cover of Forbes magazine, who donated over $100 million to political campaigns, and who told every customer, every regulator, and every journalist who asked that their funds were completely safe. His name is Sam Bankman-Fried. His exchange was called FTX. At its peak, it was the third largest cryptocurrency exchange in the world, processing billions of dollars in daily transactions for customers in over 100 countries. And in the space of 72 hours in November 2022, it collapsed completely, taking $8 billion of customer funds with it. Stay with me for the next 15 minutes, because by the end of this investigation, you will understand exactly how he built the most trusted name in cryptocurrency, how he stole from every customer who trusted him, why the people who should have stopped him did not, and how he ended up sentenced to 25 years in a federal prison. This is Verdict, because every $1 billion that disappears leaves a trail, and we find it. Sam Bankman-Fried did not fit the image of a financial criminal. He was 29 years old when FTX reached its peak valuation of $32 billion. He wore cargo shorts and a wrinkled t-shirt to meetings with heads of state. He slept on a beanbag in his office. He drove a Toyota Corolla despite being worth an estimated $26 billion on paper. He was publicly committed to a philosophy called effective altruism, the idea that the purpose of accumulating wealth is to give it away as efficiently as possible to causes that reduce human suffering. He pledged to donate virtually his entire fortune to charity. Major newspapers called him the next Warren Buffett. Sequoia Capital, one of the most respected venture capital firms in Silicon Valley, published a lengthy profile calling him a genius. Regulators in Washington treated him as the responsible adult in the cryptocurrency room, the person who understood both the technology and the need for sensible oversight. He was born in 1992 in California. His parents were both professors at Stanford Law School. He studied physics at MIT and graduated in 2014. He took a job at Jane Street Capital, a highly respected quantitative trading firm in New York, where he spent 3 years learning to identify and exploit pricing inefficiencies in financial markets. He was, by every account from colleagues, exceptionally good at it. In 2017, he left Jane Street to trade cryptocurrency full-time, founding a trading firm called Alameda Research with a small group of colleagues. Alameda exploited a well-known pricing gap between cryptocurrency markets in the United States and Japan, buying Bitcoin cheaply in the US and selling it at a higher price in Japan. This arbitrage strategy was legal, clever, and enormously profitable. Within months, Alameda was generating millions of dollars in daily profits. Sam Bankman-Fried had found his money machine. In 2019, he launched FTX, a cryptocurrency exchange designed for sophisticated traders who found existing platforms too limited. FTX offered features that competitors did not: advanced derivatives trading, novel financial instruments, and a sleek interface that professional traders found genuinely superior to alternatives. The exchange grew rapidly. By 2021, FTX had processed over $10 billion in daily trading volume. Sam Bankman-Fried moved the company to the Bahamas, where he and a small group of colleagues and romantic partners lived together in a luxury penthouse while running what appeared to be one of the most important financial companies in the world. What customers of FTX did not know, what regulators did not know, what investors did not know, what journalists profiling him did not know, was that FTX and Alameda Research were not two separate companies with an arm's-length business relationship. They were the same operation. Customer funds deposited into FTX were being transferred directly to Alameda Research and used for trading, investments, loans, political donations, and personal spending. When a customer deposited money into FTX, they believed it was being held safely in their account, available to trade and available to withdraw at any time. This is the fundamental promise of any financial custodian. Your money sits in your account. You can get it back whenever you want. What was actually happening was that FTX sent those deposits to Alameda, which spent them on leveraged trades that sometimes lost money, on investments in other cryptocurrency projects that lost value, on luxury real estate in the Bahamas, on political donations totaling over $100 million to candidates from both major U.S. political parties, on personal loans to executives, including a $250 million loan to Sam Bankman-Fried himself. By mid-2022, the gap between what FTX owed customers and what it actually held was approximately $8 billion. $8 billion that existed in customer accounts on FTX's platform, visible to customers, shown in their account balances, available to trade, but not actually held by FTX anywhere. The money had been spent. If customers ever tried to withdraw it all simultaneously, there was nothing to give them. FTX was insolvent. It had been insolvent for months, possibly years. And Sam Bankman-Fried continued appearing before Congress, continued meeting with regulators, continued giving interviews about responsible crypto management, and continued accepting new customer deposits that would immediately flow to Alameda and disappear. The collapse began on November 2, 2022, when CoinDesk, a cryptocurrency news publication, published a leaked document showing Alameda Research's balance sheet. The document revealed that a significant portion of Alameda's assets consisted of FTT, a token that FTX itself had created and issued. In other words, Alameda Research, which was supposedly a separate trading firm with independent assets, was primarily holding a token whose value depended entirely on FTX's continued operation. If FTX faced problems, FTT would collapse in value, and Alameda's balance sheet would collapse simultaneously. Changpeng Zhao, the founder and CEO of Binance, which was FTX's largest competitor and also held a significant amount of FTT tokens, publicly announced on Twitter that Binance would sell all of its FTT holdings. The reason he gave was risk management following the CoinDesk revelations. The effect was immediate and devastating. FTT's price began dropping. FTX customers began withdrawing funds at an accelerating rate. Within 48 hours, FTX was processing $6 billion in withdrawal requests, far more than it could honor because the funds were not there. On November 8, 2022, FTX halted all customer withdrawals. The exchange that had processed billions of dollars in daily transactions told its customers they could not have their money. The following day, Binance announced it was considering acquiring FTX to rescue it, sending the cryptocurrency market into a brief moment of false hope. Within 24 hours, Binance walked away from the deal after reviewing FTX's books and describing what it found as beyond its ability to help. On November 11, 2022, FTX filed for bankruptcy. Sam Bankman-Fried resigned as CEO. John Ray III, the same restructuring expert who oversaw the Enron bankruptcy, was brought in to manage the collapse. He later described FTX as the worst case of corporate governance failure he had ever seen in his career. That career included Enron. $3 million customers across 170 countries lost access to their funds when FTX collapsed. The losses were not uniform. Some customers had deposited hundreds of dollars. Others had deposited their entire retirement savings. The stories documented in subsequent legal proceedings and media investigations paint a picture of financial devastation that extended far beyond the cryptocurrency world. A retired teacher in Florida had moved her pension savings into FTX after watching interviews with Sam Bankman-Fried and concluding he was the most trustworthy figure in an industry she found otherwise confusing. She lost $240,000. Her entire retirement fund accumulated over 30 years of teaching. A small business owner in California had used FTX to hold operating capital for his company, funds he planned to use to pay employees and suppliers. He lost $180,000 and was forced to close the business. A 47-year-old engineer in Texas described taking out a second mortgage on his house to invest in FTX after being convinced by Sam Bankman-Fried's public commitments to regulatory compliance and customer protection. He lost $400,000. These were not reckless speculators chasing anonymous tokens on unregulated platforms. They were people who had specifically chosen FTX because it appeared to be the most regulated, most transparent, most responsibly managed cryptocurrency exchange in existence. Sam Bankman-Fried had spent years building that reputation specifically to attract exactly these customers. The regulatory credibility he cultivated through congressional testimony and political donations was not just reputational window dressing. It was the mechanism through which he recruited the victims. Sam Bankman-Fried was arrested in the Bahamas on December 12, 2022, 31 days after FTX filed for bankruptcy. He was extradited to the United States and arraigned in federal court in Manhattan in January 2023 on 8 criminal charges, including wire fraud, securities fraud, commodities fraud, and money laundering. He pleaded not guilty to all charges. His trial began in October 2023 and lasted approximately 1 month. The prosecution's case was built primarily on testimony from his former colleagues and romantic partners, who had also been charged and had pleaded guilty in exchange for cooperation. Caroline Ellison, who had been the CEO of Alameda Research and Sam Bankman-Fried's former girlfriend, provided the most damaging testimony. She described in specific detail how she had been directed by Sam Bankman-Fried to use FTX customer funds for Alameda trading operations, how she had prepared multiple false balance sheets at his direction to mislead lenders about Alameda's financial position. Nishad Singh and Gary Wang, 2 other former FTX executives who had pleaded guilty, provided corroborating technical testimony confirming the backdoor in FTX's accounting system and the deliberate concealment of customer fund transfers. On March 28, 2024, Judge Lewis Kaplan sentenced Sam Bankman-Fried to 25 years in federal prison. The judge described the fraud as one of the most brazen and sweeping financial crimes in American history. He noted that Sam Bankman-Fried had shown little genuine remorse, and that the sentence needed to reflect both the scale of the harm caused and the need to deter others from similar conduct. Sam Bankman-Fried is currently serving his sentence at MDC Brooklyn, pending transfer to a federal facility. He is 32 years old. He will not be eligible for release until he is in his mid-50s. The FTX collapse is not just the story of one dishonest man. It is the story of a system that failed to catch him. He operated in plain sight for years, and the entire institutional infrastructure designed to protect investors saw only what he wanted them to see. There are 4 lessons from the FTX collapse that apply to every financial decision you make from this point forward. The first lesson is that regulatory approval is not the same as safety. FTX was regulated in multiple jurisdictions. Regulation confirmed that a company exists and files the required paperwork. It does not confirm that the company is honest. The second lesson is that celebrity credibility is not financial credibility. Sam Bankman-Fried's appearances in magazines and before Congress were marketing. The amount of media coverage a financial platform receives has zero correlation with whether your money is safe there. The third lesson is that custody is everything. When you deposit funds on a centralized exchange, you are trusting that exchange to hold your money honestly. You have no independent verification that it is actually there. A hardware wallet where you control your own private keys is the only form of cryptocurrency custody where your funds cannot be secretly spent by someone else. The fourth lesson is the oldest lesson in financial history. If someone with extraordinary credentials, extraordinary media coverage, and extraordinary political connections is offering you access to returns or services that seem too good to be true, they almost always are. Sam Bankman-Fried's effective altruism philosophy, his pledges to donate his fortune, his cargo shorts and Toyota Corolla were not signs of humility. They were the costume. Sam Bankman-Fried stole $8 billion from 3 million people across 170 countries. He did it while testifying before Congress about responsible regulation. He did it while being celebrated as the ethical face of an industry desperately seeking legitimacy. He did it while pledging to give his fortune away to charity. And he did it by exploiting the fundamental trust that every customer places in any financial institution that holds their money. He is in prison. The sentence is 25 years. The FTX bankruptcy estate has recovered a significant portion of customer funds through asset sales and legal proceedings, more than many observers expected. As of early 2025, the bankruptcy trustee indicated that customers may receive close to full repayment of their dollar value claims, a genuinely unusual outcome in a fraud of this scale. The recovery does not erase the harm. The months of uncertainty, the businesses closed, the retirements destroyed, the trust broken. These are not repaid by a check from a bankruptcy estate years after the fact. Share this video with one person who uses any centralized financial platform, cryptocurrency or otherwise. Not because every platform is dishonest, but because Sam Bankman-Fried's customers were not careless. They were thoughtful people who did their research, chose what appeared to be the safest option, and lost everything anyway. The difference between them and you is not intelligence or caution. It is information. This is Verdict. Financial crime. Investigated.